Hi there, Jim McCabe here with the Knights of Columbus. Thanks for coming back. I think the reason you're here today is to find out what the difference is between whole life and term insurance. I think I've had it explained to me a variety of different ways, but the easiest way I know to understand the difference is just like this. Let's start with your age. Let's say that you're 45. I don't know how old you are, but let's guess. 45. So here you are at 45 years old, and here you are at 120. This is your life. We don't know what's going to happen between age 45 and 120, but we're pretty sure you're not going to make it. The thing we don't know is when you're going to die. Let's take a wild guess. Let's say it happens here. The difference between whole life and term insurance really, literally comes down to the dollars that you put into it. Term insurance, when you start it out, is very inexpensive. And in fact, if you think about it, that's the product that you hear advertised on the radio and television and print ads most of the time. We have cheap term insurance. We have the lowest term rates, right? Well, term insurance with the Knights of Columbus is also very inexpensive. Let's say the premium starts out low, it starts out here, but as you get older, the cost of that insurance goes up. And in fact, the older you get, the faster it goes up, something like that. That's term insurance. Now there's variations on this. There's level term. You might have level term for 10 years or 20 years or 30 years, in which case the premium is level for a period of time, but then it goes up significantly and is level again. The thing about term insurance is it's literally life insurance for a period of time, life insurance for a term, hence its name. So when that insurance expires, or when you reach the age where you can't be covered anymore, let's say for most insurance companies that's age 70 or 75. When you reach that age, the insurance coverage is gone. The insurance company says, thank you for those premiums all those years, good luck. So what happens to a lot of people is they find themselves, having purchased term insurance for years, they find themselves with no insurance at a time in their life when now it's expensive to get insurance, and sometimes their health or their age doesn't make them eligible for insurance anymore, and they can't replace it. Because of the increasing premium, because of this firewall that term insurance reaches, term insurance provides a death benefit less than 2% of the time it's written. Over 98% of the time there's term insurance in force, it never provides a death benefit. And I think the reason we get life insurance in the first place is to provide a death benefit in most cases. Wouldn't you agree? So because of that, you can look at it really simply like this. Term insurance is like paying rent. It's like renting your coverage. As long as you pay the rent, you've got the coverage. If you don't pay the rent or the landlord won't accept your rent, the coverage is gone. Enter whole life insurance or permanent life insurance. The premium starts out higher, but the difference is that the premium stays level for as long as you live. In fact, it's guaranteed that it can never go up. And with that whole life insurance, it's more like something that you own, and nobody can take it away from you except you. You have to give it up. Because of that, because of the permanent nature of whole life insurance, because it stays in force until you pass away, unless you surrender it yourself, whole life insurance provides a death benefit over 60% of the time it's written. Really providing the death benefit that you bought the life insurance for. Now there's another aspect to whole life insurance as well. Bear with me. And while I erase the board. So in the case of whole life insurance, how does it work? Here again you are at 45. And here again you are at 120. This is your life. Let's say that you started off with $100,000 of whole life insurance. That's your death benefit. first day, the first week, the first month, the first year, 5 years down the road, 10 years down the road, 30 years down the road, the death benefit is $100,000. It will never be less. But from day one, we're going to start building what they call a cash value. You've heard whole life insurance called cash value insurance before. This is why. From day one, we start building a cash value. And that cash value is guaranteed. In fact, it's guaranteed that should you survive to age 120, the policy will endow. Meaning that the death benefit is payable even if you haven't died. It's guaranteed to endow at $100,000 at age 120. Now, if you're with a mutual insurance company, or in our case, a fraternal benefit society, on top of the guaranteed cash values, we have dividends. Dividends are values within the policy in addition to the guaranteed cash value. Now, dividends are not guaranteed. They are literally your share of the insurance company's profits. If the insurance company is profitable, there should be a dividend. Those dividends that are already in the policy are never at risk. They're always there for you, and they should continue to grow. The only time that a fraternal benefit society like Knights of Columbus or a mutual insurance company does not have a dividend is if for some reason they're not profitable. So keep in mind, they're not guaranteed. But with the cash value and the dividends adding together, it can create a significant nest egg or a significant cash value that can be used for a variety of things. Most common reason for pulling out cash values? To augment retirement. Next, to educate children, to buy a home, to eliminate debt, to handle emergencies or opportunities that come up. Those cash values in the policy can be very handy. But the purpose for the cash values is to guarantee the death benefit. Remember, with the whole life insurance, the death benefit is guaranteed. It's guaranteed never to drop below the initial face amount. In the case we looked at, it was $100,000. What else is guaranteed with whole life insurance? We have a guaranteed cash value, and we have a guaranteed level premium. The premium is guaranteed never to go up. Never to go up. There's a lot of variations on whole life insurance. For example, you can pay all the premiums in as little as 5 years if you want to. You can even do a single premium life where you pay one lump sum and the insurance is paid up for the rest of your life. You should talk to your agent about this. Make sure you fully understand what your options are, what your potential benefits are, and what your potential disappointments are. It's the disappointments that catch us. Until I see you again, take care and God bless.